Hello friends! In this video I will tell you how to trade with a high probability of profit, like 80-90% or more, what strategies to use and how to make the right calculations. So let's get started. If we are talking about selling options and getting their time premium, I have already created a strategy. I have 10 days until expiration. I'm using a put option of strike 26, Bitcoin futures, and now let's see what the probability of Bitcoin futures price falling below 26,000. The option will go in the money before expiration and we get a loss. For this purpose, there is a graph of probability of normal distribution in the AE terminal. Thanks to this graph, we will be able to estimate the probability of a price event. In the white box above, I can see the price range and the probability of exit price. I move the cursor over the probability distribution graph and get the value at the break-even point, 25,800. The probability of reaching the exit price is 9%. The probability that the price will not fall below 25,800 is 91%. This means that the probability of getting a profit for this strategy is 91%. But there's one nuance. We need to know at which volatility we're calculating the probability. In the CSIV volatility of the center strike, I specified 30. Now look at the chart. It shows the historical volatility of Bitcoin futures. 21. I have assumed that the volatility over the next 10 days will be no higher than 30. You can set a lower value if you expect lower volatility. The lower the volatility, the narrower the probability dome will be, and the probability of reaching the price will be lower, so the probability of making a profit will be higher. If we put 25 in CSIV, we will see the expected volatility. Let me remind you, right now, at the time of recording, the stock market volatility is 32, 33, and if I change it to 25, I see a 5% probability of the price reaching a loss zone till expiration. 95% is the probability that the price will not fall below the break-even points and we will make a profit on the sale of this option. That was a simple put option sale, but now let's look at the strangle strategy. A popular strategy where we have sold put options with strike 26 and call options with strike 29,500. We look at the confidence range, 5% that the price will go below the break-even point. The break-even point is lower because we're using an additional call option and it's now 25,500. And on the right side, the probability is 5.76%. Therefore, there's an 88 to 90% probability that we will make a profit with this call option. But don't forget that volatility may increase and the probability of profit will decrease, while the probability of risk may increase. So you should always be prepared for risk management, like delta hedging when the price gets close to the strike. You can also buy back options that have been sold if they get cheaper. Rolling is also a good variant. Roll up to further away strikes if liquidity and your deposit size allows. Let's try to work with weekly series options. I'm demonstrating all this now so that you can repeat it later and choose the strategy that is best for you. For example, let's try to sell a put option with strike 27 and a call option with strike 29,500. 1,000 contracts for ease of calculations. We end up with a strangle, but with a shorter series. And let's assume that the volatility will be 27. The probability dome is displayed after the quotes change. The market is not very active, so I can change the price of the asset a little bit and then it will appear. Now let's look at the break-even points. One is in the 26,700 zone, and I see that the price range is 83%. And the call options have a break-even point in the 75% zone. Exit price is 12.5%. That means that 12.5% is the probability that the price will exceed the break-even point of 28,750. And the probability of the price falling below the break-even point is 8.67%. 12 plus 8 is 20%. So 20% is the probability of making a loss. 80% is the probability of making a profit at a volatility of 27. If volatility goes down to 21, then yeah, you have to change the price a little bit to get the chart to update. At the volatility of 21, the probability that the price of the asset will rise above the break-even point is 6%, and the probability of falling is 3.874%. 6 plus 4 equals 10. Therefore, more than 90% that this strategy will make us a profit. How much profit? $238, with margin requirements of 4,666. A profit of 5% in 4 days. This is how you can calculate the probability of profit. But remember that the formula used is the normal probability distribution. So please use this tool to calculate the potential profit and assess the risk of your strategy. Think about it and draw conclusions whether you should use this strategy or not. If you still have questions, ask them in the comments. If this video was useful, leave a like so that other traders could find this video. Subscribe to the channel. I wish you good luck and successful options trading.